And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
It's that time. Hello, everybody out there in RIA land. Welcome to The Real Investment Show, Financial Fitness Friday edition. I'm Jonathan Penn. All my friends, family, clients, they call me John. My wife, Shauna, calls me Jonathan when I'm in trouble. Joining me in the arena today, as I like to say, joining me here in the studio is my advisor colleague, Jonathan McCarty. His name is Jonathan. He is not in trouble. Jonathan McCarty, there are a lot of initials behind his name. CFP, CFA, NSSA for the National Social Security Advisor Certification. But there are some initials behind his name you don't see, and those are D, A, D.
The most important of all.
The most important of all. He's a new dad, man. How are you doing this morning?
Doing good, John. It's good to be back in the studio with you. Thank
Likewise.
You. Yeah, I don't know about you, but when I'm in trouble, my wife uses my middle name.
So,
she pulls the mom card already. Yeah.
Oh man, that didn't take long.
Get serious.
That's it. It's just like, cool. Yes. Okay. So I'm going to ask, what's your middle name?
My middle name is Earl.
Earl.
Yes.
So if you hear Earl, it's on.
I'm as Texan as it comes. Yeah. Actually named after my grandfather who was born in Lubbock. So
I love that.
Yeah. That's right.
So
Earl.
if you hear Earl,
I tell people it's actually Earle. There's an
Earle.
E on the end. It's French. Yeah.
It's fragile. It's early. It must be Italian. Yeah. Well, no, it's good to be in here with you.
Thanks,
So Jonathan and I, we've got quite a bit to get into this morning. So we'll see. We'll try to kind of cram everything that we can in here with our time together here. But just as of late, markets and narratives. We'll talk about the market a little bit. So far, I'm seeing green on the screen, Jonathan. Looks like S&P futures are up a little over 7. Looks like Dow futures are up 54. Let's just take a look and see where the 10-year is on the yield on the 10-year Treasury, sitting around a 4.4. So it's been hovering kind of around that 4.4 spot here for a while. But as of lately, it just seems like there's just been this appetite for like more speculation or maybe taking on more risk. And we saw that with some of the meme mania, kind of, if I could relate that to Hulk mania. Sad to say that
he will be missed.
Hulk Hogan passed away yesterday. A lot of memories from my childhood, right? Mm-hmm. Ozzy Osborne. Oh my goodness. I mean, what a week it's been. But it does seem like as of late that investors have like this appetite for speculation. And we saw that with, companies like Krispy Kreme, Opendoor, Rocket Lab, Kohl's. You look at the symbols on those: donut, open, RKLB and KSS. You take the first initial. It's did you become a dork? Did you invest in those? Right? But it seems like the meme media around that was kind of short lived, don't you think?
Yeah, I think it was. It was kind of surprising, not like what we saw back in 2021, but it kind of goes back to what Mike and Lance were talking about yesterday. And now there's so much algorithmic trading involved in this that's starting to shorten the cycles of these basically pump and dumps. I mean, essentially, it's a pump and dump. And as soon as I started seeing articles about Opendoor, on my news feed, it was already over. And you saw it, shot up to $5 and then tanked back down. Now it's up and down 20% a day. I mean, there's probably still going to be some volatility, but I think that that pump and dump is done.
You kind of seen the most of it, right?
Yeah.
It's just really interesting. So with individuals and families that I've been visiting with as of late, they've said, John, how are you doing? How are you holding up this year? And it's like, it's hard to believe. It's really hard for me to believe that we're almost through the month of July.
Yeah.
But I've been telling folks, I feel like I've been in 2025 for 5 years already. It's just been kind of one narrative after another this year. I mean, earlier this year, it was all around, tariffs, and are they on? And now they're not. And maybe they aren't, not as much as they were. And, how are the markets reacting to that? And then as of late, it's been kind of this fever around, meme stocks and, or the market has a fever. It needs more cowbell. It's just, it has this appetite for risk, right? It's like a risk on and a risk off. But I think now too, Jonathan, I think folks are kind of eyeing next week, Federal Reserve meeting next week. What's the Fed going to say? And is a rate cut in the cards? I think as of yesterday morning, I think a interest rate cut next week, I think the likelihood was less than 3%.
Yeah, it was. And we talked about this yesterday morning as well.
Yeah.
When you look at this coming meeting versus the September meeting, I mean, the jump is staggering. It's like a 60% expectation of that rate cut in the September meeting. And to be honest, we're going to need to have one in the September meeting if we're still going to track for that 2 cuts before the end of the year.
Yeah, so I think it will be eyes on the Fed next week. Not so much what does he do. I think it's more around what does he say and how do markets react to that. Also too, right now there are some pretty big names, pretty big companies that are reporting earnings next week. Alphabet just reported, I think it was just yesterday, had good earnings, and market responded well to that. But companies such as Tesla, Microsoft, Meta, Apple, some of those big names that markets are paying very close attention to are reporting earnings next week. Companies such as Palantir, Nvidia, also been very popular names for folks to really pay attention to this year. They're going to be announcing in August. And I don't know, Jonathan, I don't know if it's around, if the earnings announcements, if folks are paying attention to, well, how did these companies do last quarter? I think it's more around what does that forward-looking guidance look like? Yeah.
I'm especially interested in Tesla, given what's been going on with their declining sales.
Yeah.
Elon Musk is kind of unfortunately alienating a lot of his base by some of his involvement in the political sphere. And, whatever side of the spectrum you fall on is relevant. As a business owner, your job is to the shareholders. And so if your conduct outside of the operation of that business is detrimental to your business in general, you really need to reevaluate your strategy.
Yeah, that is a concern that I've heard from folks that either own Teslas, but I will tell you, folks that own Teslas, that drive them, love them.
Yeah.
They are so loyal. They love them. And I have seen more Cybertrucks driving around Houston lately than I've ever seen.
They're catching on.
They are catching on.
Yeah.
And I think they wrap them like with all these different colors. And I mean, it's like a Cybertruck nation out there right now in Houston. Who knows? But yeah, Tesla has been, that's been a pretty interesting story this year. And it kind of, I've noticed too with the narratives that we've been having this year, all of the storylines of the market, I've been noticing some key investor behavior. And so I want to put on my psychology hat here for just a moment. And one of the trends that I notice is when, as investors, where we evaluate our own investment success by comparing how are we doing to the performance of others. Maybe it's a market index. Maybe it's, what are you hearing from your friends and neighbors? Are there headlines out there telling you, hey, this is how things are performing this year, and you're comparing that to yourself, and maybe you think you are not kind of quote unquote keeping up. And the technical term for this is they call this relative performance bias.
Yep.
Right. And this can lead to, if you feel like you are missing out or you are not performing like with the rest of the herd, and it can lead you to make some decisions with your portfolio that could be detrimental, right?
Yep. Well, and even thinking meme stocks, that's herd mentality, that's bandwagon effect. Those are cognitive biases as well that definitely align with the meme stock craze.
Oh, absolutely. So we'll touch base on this a little bit more when we come back. So, hey, thanks for joining us here on the Real Investment Show this morning. We'll be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security? And how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. Realinvestmentadvice.com.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV, starting August the 4th, we'll be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back. Welcome back from the break. Welcome back to the Real Investment Show. Java Joe in the chat says, 2 Johns. This is weird. You're right. It's J squared today in the arena. We got 2 Johns, Jonathan and John.
You know, 2 rights don't make a wrong, but 2 Johns make a right.
2 Johns make a right.
Hey.
Especially when your middle name is Earl. So man, this week, Jonathan, there are a couple things this week that have kind of reminded me that I'm just getting a little bit longer in the tooth, just getting a little bit older. So I mentioned Ozzy earlier, Ozzy Osborne. He was 76 years young. Bless his heart, I'm surprised he made it that far.
Absolutely.
Hey, good for him.
Miracle of medicine.
And he just did his farewell concert earlier this month. I think it was like on July the 5th, and it was incredible. So timely. But then, Hulk Hogan. I remember as a kid wrestling. It was, Hulk Hogan. I remember when he wrestled Andre the Giant and picked him up and body slammed him. It's incredible.
Of course, I thought that was real.
Of course, it wasn't fake. What are you talking about? Of course, it was real, right? But remember the Dingo Warrior?
Yeah.
Remember him?
Yep.
Oh, he was natural, right?
Ultimate Warrior.
Ultimate Warrior.
I went for him as Halloween.
Yeah, he went for Halloween.
I definitely went as the Ultimate Warrior for Halloween. Spandex. All spandex.
I like that. But he was natural, right?
Yeah, of course.
But you remember? I just so many memories of my childhood. Remember Hacksaw Jim Duggan? Mm-hmm. The 2x4. Oh my gosh, so good, right? So sorry, had to reminisce there for just a little bit. So before the break, we were talking a little bit about just market behavior, investor behavior so far this year, and it's just been an interesting year of narratives and headlines of investor behavior, psychology. And we were talking a little bit before the break around that relative performance bias where you're kind of comparing your own returns to that of others or market indices, or you're looking at all of this craze with these meme stocks, and are you keeping up with this? And if you're not, maybe feeling down on yourself, it can make you to make some short-term decisions that maybe it really don't work out for you for the long term. But I've noticed this too, as of late, Jonathan, where as investors, we look at our portfolio and you look at all the different holdings that you have in your investment portfolio. And rather than looking at the portfolio for the sum of the parts as a whole driving engine to move you forward, we get in there as investors and we kind of nitpick from one position to the next, right? Mm-hmm. So even though this year the total return of your portfolio, you might be performing very well so far this year, but you get in there and you look at that one company where you see right on your screen, and it just, for lack of better words, it just drives you nuts,
right?
And then you're just like, well, why do I own it? Does it even make sense to own it? And you're not focusing on the total return, the total positive return of the portfolio, but just that one you see the red on the screen. And that's called narrow framing, where you're kind of framing in on that one specific position. So if you encounter that, Jonathan, as you're talking, because I know you visit with a lot of clients, you work with a lot of individuals and families, do you see that type of behavior as well at times?
Oh, absolutely. I mean, when you were talking about quarterly review season, it's really, what positions in the portfolio aren't doing well and why are we continuing to hold them? And what people sometimes forget is that they're part of a whole portfolio, right? And they serve a purpose. Great example. When things were melting down back in spring, our bond positions are what helped buoy the portfolio and kept you from being in the red in most of our portfolio models.
Yeah.
So, you have to take it in consideration of the whole and how does it interrelate with the other holdings in your portfolio? What's the correlation between the two? That's where you get the smoothed out volatility of returns that we are targeting.
Right. So you're talking about bonds. So literally just yesterday. Mm-hmm. Yesterday afternoon, I was having a conversation, and the question that was posed to me was, John, why do we even have bonds in the portfolio right now? Right? Why don't we have more equity exposure? And I said, well, let's go back a couple months, like you just mentioned. Let's go back and look at the month of April, and what did the markets do earlier this year? When you look at how the equity markets performed, like from the first trading day, January the 2nd, to the pull down of the market on April the 8th, depending on how you measure it, the S&P 500 during that period of time was down just shy about 16%. The NASDAQ, again, depending on how you measure it, was down about 19%, right? And then my response was, well, let's look and see how your portfolio did during that period of time. And look how bonds really help provide ballast.
Yeah.
So even though you may look at your portfolio right now and there are certain positions in there that might be kind of out of favor, it still makes sense to own them.
Correct.
Right?
Correct. Well, and how many times do we show the chart about, which sectors or segments of asset classes are performing at the top each year? Everyone's seen that chart that shows whether it's small cap, whether it's large cap, whether it's fixed income, whether it's tips. I mean, that changes year over year. And so if you try and only focus on the hot one right now, it goes back to the meme stock craze, right? If you're following the crowd, you're probably going to miss the mark.
Yeah. Yeah. And I will tell you, the financial custodians out there, wherever you hold your dollars, they all have very strong, robust platforms. But I will tell you, their gain loss page does not do you guys any favors.
Yeah.
Right. Because when you look at the gain loss, it's a quick way to see what's green on the screen and what's red. But typically, your gain loss page is only showing you price appreciation or price depreciation, and it's not taking total return into consideration, right? Those income streams, dividends, interest payments. And so don't necessarily let that gain loss page be a driver. And that's a very quick way to start framing yourself.
That's right.
Right?
Yep.
So let's shift here just a little bit. So it's the summer.
It is.
Right? We work with a lot of families, Jonathan, who have teenage kids, young adults, kids that are, either in high school about to go to college, or they're in their college career and they're getting close to graduation. I know our own youngest daughter, Andy, she just turned 23 on Wednesday this week. Another sign that I'm getting a little long in the tooth. But she'll graduate. She'll have her undergraduate this upcoming December, right? So, but there's just a lot out there about kind of that Gen Z, as in zebra, not C, Z, that age group, and some of the challenges that they're facing, in the job world.
Yeah.
Right. So
real concern.
Yeah. So what are you what are you seeing? What are you hearing? Just with your own experience with working with folks and younger adults.
Yeah, as financial planners, we definitely always want to talk about opportunities and the investment associated with those. So when you're looking at the shift that we're seeing for new college graduates coming out, 15 years ago, college graduates were coming out and the unemployment rate for college graduates versus non-college graduates was about half. It was about 7% for college graduates, about 15% for non-college graduates. Now we're seeing the unemployment rate is actually about equal. In fact, non-college graduates have a little bit of a leg up on college graduates. So that's a staggering figure when you're talking about telling your children, okay, this is the right path. Go this way. Get a college degree. This is the key to success. But we're seeing a pretty staggering shift in supply and demand within our job market. Where are the opportunities that exist? McKinsey put out a great study that talked about this, and that we're seeing a shift on the supply side, specifically in those vocational trades. And I know Lance touched on this yesterday, his quote from Mike Rowe about the opportunities in trades, the professional trades. They are the dirty jobs, right? Mark Rowe is famous for that show. But they also have job security. If you're looking at what's going to be able to insulate you from the impacts of AI, it's going to be those jobs that are not able to be automated. So I think that's a really great point that is made. And McKinsey, consulting company, put out a study that talked about how we're seeing a drop-off in the supply side. Most of the workforce in these skilled trades, they're aging out, and they're retiring at record numbers. And so we're looking at shifting demographics from, roughly a 2 to 10 working age to retired individual format to roughly 3.5 to 10 for retiring age individuals versus working age individuals. So we're seeing an increase in aging out of our population. That's creating a supply constraint in the labor market for those skilled trade jobs. And we are students of economics. We know how that's going to work. That's going to result in increased wages. And we've seen that already being reflected. So right now you're seeing better wage growth coming from the private sector in trade schools than you are from actual white-collar jobs. And so, some people ask, well, Jonathan, I've saved up this 529. I've got this big pool of money that I was supposed to save for my child to go to college. What am I going to do with that? Well, a lot of people may not be aware those 529 accounts, they're able to be used for vocational and trade school costs. So you're not only limited to higher education. In fact, 529s can be used for K through 12 as well. Now, not typically a benefit that we would recommend because you lose out on the compounding tax-free growth of those investments. So not a strategy we typically would recommend unless, you're starting early. Like I just told one of my colleagues, one of my clients the other day, I've already got a 529 account set up for my son. The kid can't even walk yet, but he's got a 529 account, and we're starting those fundings already. So, if you have started early, maybe you may want to use that for private high school if that's the direction you want to go. But even if you have a significant 529 balance, don't let that be something that directs the advice you give to your children. That's, I think, one of the biggest jobs of any parent, and something I think a lot about now that I am one. What kind of guidance am I going to give my son about where the opportunities exist when he gets into the working world?
Oh, absolutely. So you're talking about the 529 plans and starting early. That reminds me of a story. So our next door neighbors have kids that are a little bit that are younger than our daughters. So they're elementary school age, and as I was visiting with our neighbors, I was also able to visit with their parents, and they were talking about when their kids were born. And the dad went to the hospital to see his daughter right after her first child was born, and he literally walked in the hospital room with a 529 plan application and said, "Here, sign this. Congratulations, sign this."
My kind of client,
right? Yeah. So right there, day one, getting started on the 529 plan, and some additional thoughts around that too. Maybe when we come back, where if there's money left over in the 529 plan, are there some options that can be used for that?
There are quite a few. Yeah. Talk about those.
So we appreciate you sticking with us here on the Real Investment Show. We'll be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security, and how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. Realinvestmentadvice.com.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV, starting August the 4th, we'll be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
If Lance dressed up like Danny, maybe his wife would listen to him. No, that is not the case in my household. I actually had this conversation.
She wouldn't listen to him anyway.
The Real Investment Show podcast.
I had this conversation with my wife yesterday. I told her no on something she wanted to do. And she goes, I'm sorry, I think I misunderstood what you said.
Same show, your schedule.
You meant, yes, you can do that, right? And I was like, yes, honey, that's what I meant. So, yeah, she goes, I'm going to do what I want to do. I'm like, okay.
All right, love you. See you.
Exactly.
At realinvestmentadvice.com.
I could wear a tuxedo, and she is not going to listen to what I have to say.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back, y'all. Real Investment Show, Financial Fitness Friday. Here with me, Mr. Jonathan McCarty. So, just quick check on the chat here. Java Joe, you stuck out to me again, where you say John Penn's a Hulkamaniac. So I remember Roddy Piper, Ric Flair. Woo! Was it George the Animal Steel? He would eat the turnbuckle, the stuffing out of the turnbuckle. I mean, come on. Do they make entertainment like that anymore?
The Legion of Doom?
The Legion of Doom.
Oh, man.
The Undertaker.
Oh, the Undertaker.
These are bringing back horrible memories of my childhood because I had two older brothers. And so all of these wrestling moves that we would see, they would try out on me. You know, the Nasty Boys. Remember the Nasty Boys?
Yeah.
Can't tell you how many times I spilled my brother's armpits because of those two. Yeah.
Jake the Snake, baby. DDT. It's coming at you. So we could just talk about this for the next 30 minutes. We'll be just fine. No.
That's right.
So
American pop culture.
Yeah.
There it is. Good, wholesome family entertainment,
That's
right?
right.
Very good. As I date myself even further with everybody this morning.
It was like a soap opera in tidy whities.
Kind of was. kind of was. And as
the
wrestlers kind of got a little bit older, it's like, you're still wearing those tighty whities. It's like, oh man, I don't know about that. More power to them. So before the break, we were talking a little bit about the younger generation, folks that are, kids, young adults in their high school careers, coming up out of high school, getting ready to go into maybe, post high school education, college, whatever that looks like, and just kind of the job market today and what opportunities are out there for folks, right? And I do hear on a very regular basis from clients where their kids are at that stage in life, and we visit with a lot of their children, by the way, talking about, career development, when they kind of get their first, post-college career job, what are things to look at, from medical benefits, retirement plans, 401ks, Roth 401ks. But first, you kind of have to kind of get that opportunity first. You got to find that employment opportunity, right? And so, just before the break, Jonathan, we were talking a little bit about, kind of that skilled profession area of the workforce, because it's always been, hey, go to college, get your four-year degree, go to college, right? And you just look at what, even public, like 4 years at a public in-state school will cost.
Right.
And talk, if you wouldn't mind, maybe kind of share, kind of what you're seeing when kids are getting out of school, just with student loans. Like what kind of debt burden are you seeing?
Yeah, I mean, the Economic Policy Institute put out their study. The average college graduate is graduating, and this is a public 4-year university, graduating with almost $40,000 of debt. If you went to a private, nonprofit education, that's another $10,000 on average. So the costs are there. When you consider that to something like the trades, a lot of these apprenticeships, they're paid.
Yeah.
You get paid and you're getting the training, so you're coming out a leg up. We're financial planners. We understand the impacts of compounding interest. And some of these loans that kids are taking out for school, they also accrue interest while they're still in school. So they may take out a loan that could balloon by $10,000 before they actually get out the door and start seeing any return on that investment. It's a smart conversation to have.
Absolutely. And I think it's, as parents, moms, dads, or if you are in a role where you are somewhat mentoring or taking care of a younger adult, is to have some conversations around income expectation when you're coming out of school.
Yes.
Right.
Yeah.
Either whether if it's a 4-year degree, if it's an undergrad, or if you're going to go study, look at graduate school, medical school, if you're going to become whatever the kind of the role is that you're wanting to achieve. Because I think there's a little bit of a disconnect between what, kind of that Gen Z age group, what they expect to earn salary-wise when they graduate, compared to what reality is.
Right. Yeah, I mean, and they think, they want that 6-figure salary coming out of college, and that's just not the case. I think the average income for college graduates somewhere around $65,000-$70,000.
Right. Yeah.
Right, and that's also varies widely by industry. If you're in the finance industry, you probably have a much better option than somebody who becomes a teacher. What I always found funny about, growing up, and teachers always saying, oh, well, make sure that you go to college or you're going to end up as the garbage man. Well, what they didn't tell you is the garbage man made 3 times what they made and gets a pension when he retires.
That's right. They get the pension from the city.
Right. Yeah. So there's this negative stigma around the professional trades, and it's even prevalent within the younger generations. There was a recent study that was put out, and I want to say it was that's of Economic Policy Institute again. They were talking about that the stigma around Gen Z and how they view the professional trades. I mean, 74% of them believe there's a negative stigma associated with working a manual labor type job or a more hands-on type of job.
Yeah.
And I think that's also driven largely by the parents. That same study quoted that 79% of those respondents said their parents were really pushing them to go to college and look down on pursuing any type of trade school. So it really starts at the home and the types of information you're giving to your kids.
And I will say, look, there is something about being able to craft something and build something with your hands.
Right.
And it's really a lost art.
I and some of my clients already know this. I didn't know that I wanted to go to college right after high school.
Yeah.
Like many people, I had not the best high school experience, and so I didn't know if I wanted to dive right back into that. And so my father told me, hey, okay, well, not everybody has to go to college, but if you're not going to go to college, you need to start working because you're not going to live at my house for free. And so he made me start working with him. My father was a carpenter, construction worker before starting his own business, in construction. And so I was the boss's son on the job, swinging a hammer. And I was the first one on the job site every day and the last one to leave by his mandate, or I was fired. And it taught me a couple of things. Number one, that I wanted to work with my mind, not my back, but also the value of hard work and some skills that I still use to this day. When things break around the house, most of the time I can fix it. And when I can't, it's defeating. And
it's defeating. I feel so deflated. Yeah, I know. There's a lot to be said about that. And you look at the cost of kind of quote unquote traditional education, right? College, undergrad, whatever, and whatever that might be. But you look at what the cost of maybe entering a skilled profession, whether if it's being a plumber, welder, an electrician, right? Typically, the cost for those to get the training and the education for those skilled professions is less. And you look at some of the starting wages or salaries, like for an electrician, for example. I mean, it's right at or just over $60,000 a year.
Yeah.
And I would think too that those numbers could potentially be higher, especially if you have you've been in that trade for a number of years, and you maybe have a specific niche that you can do extremely well.
Oh, absolutely.
And as a student, as you were learning that craft, you're not burdening yourself down with all that debt.
Yeah. I mean, I was a finance guy coming out of college, and my first job, the salary was $35,000.
Yeah.
And you look at some of these electricians that are getting double that. I mean, now I'm dating myself because this was a long time ago when I graduated from college, but Lance and Michael talked about it yesterday. The booming AI industry is causing the demand for electricians, specifically skilled industrial electricians.
Right.
More importantly, they can make upwards of $150,000. That's nothing to sneeze at. That's almost twice the national average.
Exactly. But I'm seeing that. I mean, just here in Houston, a lot of the high schools there are. I remember when I was going to junior high and high school, kind of the trade quote unquote area of the building was this like small dusty corner where they had a couple tools like wood shop, and it was kind of off in the back. Now the facilities for learning how to weld, if it's a plumber, all of these skilled trades, these are major hubs within these, within high schools.
Yeah.
And they're and you know what? And they should be. They're very proud of this.
Yeah.
To be able to teach this skill set, because it's really kind of been lost. And to your point, kind of the folks that have been in this industry now for quite some time, as they get older, you need to have that younger generation to come in and kind of pick the ball up and keep it going. Yeah,
I mean, welding is an art form. I actually I took some welding courses, before I decided what I wanted to do. Again, my father was in construction, so he was kind of, hey, if you want to do welding, there's some opportunity here.
Yeah,
that is hard. If you ever had to stack nickels as a welder, I mean, I tip my hat to you. The test for that, you have to weld above your head, and you have to do 6 beads in the corner of 2 plates of metal. I mean, it's challenging.
Absolutely. Yeah. And we were talking a little bit too. Just a few minutes ago, we were talking about 529 plans. And there's been some recent changes with 529. So let's say you've put money in a 529 plan, and you can use that for, these, as long as the institutions that you go to are, qualified, you can use money from 529 plans to support that education, right? But let's say you were through your educational career and there is money left over in that 529 plan for you that you didn't use, and you really don't plan on, let's say, allocating that money to somebody else, because that is something that you can do. But before you do that, maybe, with some recent changes with 529 plans, if there's money left over in there, potentially that money could move to a Roth IRA.
That's right.
Right?
Yep.
So would you maybe share a little bit about that,
Yeah,
Jonathan?
so talk about giving your child a leg up as they're coming out and entering the job market after whatever type of education they decide to pursue, if any. If you have leftover funds in your 529, you can convert, and I think it indexes for inflation, but I believe the total right now is around $35,000.
$35,000 is a lifetime.
But it is an annual limit of right around $8,500. So, and that will index up. But there are options out there to save those funds and give your child a leg up. And to the point, there was a question in the chat. Yes, as a grandparent, you can open a 529 for your grandchild. And hi, Blair.
Very good. So we appreciate y'all sticking with us. Chat, we appreciate you. Thanks for tuning in with us here on The Real Investment Show. We're coming up on segment 4, right? Time flies when you're having fun. Stick with us. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security? And how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV, starting August the 4th, we'll be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, everybody out there in RIA land, we're back here for the rest, wrapping up the Real Investment Show this morning. Thanks for spending some time with us. I was checking the chat. Pistol Pete, 529 plans are great for meme stock trading. No, Pistol Pete, no.
Please don't.
No. It's so interesting when memes started first coming out. Again, I'm going to date myself here. Our daughter's like, Dad, check out this meme. I was like, I thought they were called memes. It's a meme. It's a meme. It's a meme. But no, Pistol Pete, no. Don't trade your don't be a dork in your 529 plan.
That's right.
All right. Now I've lost my train of thought. Okay, I'm back. So, hey, when you get a chance, stop by our website, realinvestmentadvice.com. A lot of great information on there. Go to our blog, go to our resource section where all of the videos that Brent, our wonderful producer, is so kind to record and edit. He will upload all of that information to our website where you can view that at your viewing pleasure. As Lance and Mike are researching markets, Lance, Danny, Rich, they're writing articles about various topics. They publish all of that information, all of that research into a form of an article, and they put it up there on our blog for you to use. It's wonderful information. You can also sign up for events. I know coming up here in August, Rich and I are going to be talking about Social Security. Jonathan and I, we all get a lot of questions around Social Security. Go by realinvestmentadvice.com. You can sign up for that. It's going to be on Saturday, August the 23rd, 8 o'clock Central. So we'd really love to see you there. Jonathan just did an online webinar with Rich. Was it last Saturday?
It was, yeah.
About just the retirement blueprint, right? What do you need to think about if you're nearing retirement? You're driving on the freeway and you're starting to get over into that right lane. You want to exit that freeway. What are some things that you need to think about as you're nearing retirement? If you weren't able to catch the live version, you can catch that recorded version online. It's all there for you to use. So wanted to make sure I mentioned that. So Jonathan, earlier in the show, I mentioned that it's hard for me to believe that we're already practically through July already. Like I feel like 2025 is moving along pretty quick.
Yeah.
And this is the time of year as we kind of get into Q3, mid to late Q3. Q4 will be here before we know it. there are a couple of housekeeping items that I just always want to make sure that individuals, families, clients, that we're just being mindful of, that we take care of before the end of the year, because December 31st will be here before we know it. And then it is soon to be 'tis the season for RMDs, required minimum distributions, right? And these need to be done by December 31st. But what if you're turning 73, as I like to say, 73 years young this year?
Yep.
Right? So you're turning 73 this year. You have an option.
You do. You can actually delay that initial RMD until the next year. Now, the caveat there is you have to take the double RMD right next year.
Okay.
So you do have to take more, but you can delay it if you're concerned about income levels that you're currently at, or if you're looking to implement some Roth conversion strategies and would like to avoid having to take that initial RMD, then you can push that off until the following year.
Yeah. So, but that's a key point, because I think sometimes folks fail to realize if they delay their RMD for this year to next year, you're going to take 2 RMDs. So if you're turning 73 this year, and this is the first year of your required minimum distribution, if you decide to take it in 2026, you're not taxed on it in 2025. You pay the tax on it in 2026 in addition to the RMD that you need to take out in 2026, right?
That's right.
So you can't backdate it, right? So also too, in the world of required minimum distributions, there are a lot of folks that we work with who have inherited IRAs, and especially non-spouse inherited IRAs, and the rules around those have changed. Where it used to be, I think it was before 2020.
2020, correct.
As a non-spouse, as a child, or a non-spouse beneficiary, as I inherited that IRA, I could then stretch my required minimum distributions over my lifetime. It was called a stretch inherited IRA. That's no longer the case. Now for a non-spouse beneficiary, that money has to be distributed by the end of the 10th year following the original account holder's passing.
That's right. Yeah, and a fringe impact of that is that now people are reconsidering how they want to pass on assets to their heirs.
Yeah.
If you're looking at $500,000 in pre-tax IRA assets, then maybe looking at Roth conversion strategies becomes much more appealing to you. Considering the direction that tax rates seem to be heading, with the shifting demographics, I expect that when I'm inheriting anything from my parents, the tax rates will be a bit higher. You look at our blooming deficit and budget deficits on an annual basis. There's really only one way to change that.
Yeah. I nobody can predict the future. I'm there, but do we think that income tax rates will be higher or lower? I'm on the higher side as well.
I am as
right?
well.
And so you can. So talking about those Roth conversion strategies. So if you want to get a Roth conversion done for 2025, that also needs to be done by December 31st.
Correct.
Right?
Yeah.
And around as we're getting into Q3, kind of late Q3, early Q4, this is a good time of year where, Jonathan, folks will have a pretty good idea of kind of where they're going to fall income-wise, looking at dividends, interest, whatever sorts of income that they have, right? And kind of where do they fall in a certain bracket, and is there a certain amount they can convert to kind of take advantage of that bracket or fill up the bracket without maybe having some bracket creep, or depending what the bracket is, maybe they creep in there just a little bit, right? So this is a good time of year where we're helping folks look at their income. But maybe for mom and dad, maybe the Roth conversion from a number standpoint, maybe the math doesn't necessarily make sense for mom and dad.
Right.
But I have a lot of parents that I work with who will still convert to Roth because they're thinking about their children.
That's right.
Right. And so it has become that Roth conversion has become a very key component of looking at wealth transfer, because an inherited Roth IRA, a non-spouse who inherits a Roth IRA, does the money still have to come out of that inherited Roth IRA over 10 years? Yes. But it comes out tax-free.
Exactly.
What a gift.
Yeah.
Right?
Well, for most people that are inheriting IRAs from their parents, as an example, they're probably in their prime working years.
Yeah.
They're in their 50s, maybe early 60s, depending on the age gap between your parents. That's going to be your highest marginal tax rate years. That's
right. So have a lot of moms and dads that are kind of thinking ahead a little bit. And if maybe Roth conversions don't necessarily make sense for them, they're thinking about their kids, right? So speaking about IRAs, Roth IRAs, SEPs, Simples, annuities, life insurance, anything that has a beneficiary designation associated with it. And this sounds so basic, right? So basic that I just hit the microphone with the side of my face. I get so excited about this stuff. And I see Brent laughing over here. So I did my job. Seems so basic, but Jonathan, how many times do we, when we're visiting with folks, I know I see this quite often where, over time you start to kind of collect IRAs because maybe you were, working with a previous employer, and then you have an old 401k plan there, and you move that to an IRA through a rollover, and you have an IRA here with this custodian, you have an IRA over here at this custodian, you have like this Beanie Baby collection of IRAs, and not all of them have IRA beneficiary designations on them.
Correct. Yeah. Or if you're in a situation where you had an IRA created for you. I know a lot of companies are dissolving their pensions. And if you do not take that distribution and you do not respond to those mail notices, they'll just roll those funds into an IRA for you. That IRA would not include a beneficiary.
That's exactly right.
Yeah.
And if you move an IRA, let's say you have an IRA at custodian A and you're trying to consolidate or, bring those IRAs over to custodian B, if that's a brand new account at custodian B and you haven't set beneficiary designations on there, whenever you transfer an IRA from one custodian to the next, basically what I'm trying to say is your beneficiary designations don't come along with it.
That's right.
So you just take as I'm going through and helping folks with IRAs, I'm always looking at beneficiary designations to make sure they're up to date, because I've caught times where the IRA owner will designate themselves as the beneficiary. And I get it, because sometimes when you're on there to try to add your beneficiary information, you're going so quick, you don't maybe realize whose IRA that you're in. But I've caught that a couple of times where I'm like, no, you designated yourself as the beneficiary. And usually the wife will turn and look at the husband and go, really?
Because you can't take it with you.
You can't take it with you.
I give to the charity of myself.
Yeah. That's it. That's right.
I am a nonprofit.
Yeah.
I am my own beneficiary, right? So kind of along those lines, beneficiary designations. Here's the real fun stuff, right? Have you done your estate planning?
That's right.
Do you need a will? Are you in a situation where maybe a trust makes more sense? There's pros and cons of each. Mm-hmm. There's not a right way or a wrong way to structure an estate plan, right? What about your powers of attorney, right? How many times? I know when I visit with folks, maybe sometimes initially we're so worried about stocks and bonds and what the markets are doing, but there's a bigger element of risk management that we fail to focus on, and that's estate planning.
Correct. Yeah.
Right.
Even things like health directives.
Yeah.
Durable power of attorney versus standard power of attorney. There's some significant differences there. So make sure you're aware and that your intentions are followed by the instruments that you have in place.
That's right. So if you haven't put your estate plan together, I can't tell you how many folks I visit with where I'll ask that question, hey, have you done your estate planning? And sometimes, especially if it's a couple, heads will turn and look at each other. Then they look back at me with that stare in their eyes. And I already know what the answer is going to be. And sometimes I hear, you know what, John, we've been meaning to do that for the last 20 years, but we just can't ever seem to get to it.
Yeah.
So I'll say, you know what? We're halfway through 2025. Let's get this done for the second half of the year. Make it a goal to have these documents in place by 2026. So as advisors, as your fiduciaries, Jonathan and I are here to help you. We kind of remind you to eat your vegetables every once in a while, right?
Take your medicine.
Take your medicine. We need more time. That's it. That's the full hour, folks. We appreciate you being here with us. Thank you for joining us on the Real Investment Show with us this morning. Stop by our website, realinvestmentadvice.com. Let us know what you want to hear from us. We're always looking for topics that we can share with you. We appreciate you staying with us today. Enjoy the rest of your day, folks. Thanks so much.